day. Ira Epstein of Linn Associates with your financial market wrap-up for this Monday, the 16th of March, 2020 at 4:40 p.m. Daylight Savings Time. So as we're looking at the markets, a huge decline today in most indices, some down the 13% limit again right at the end of the day. And what we're getting now is, I'm wondering about the scenario. Is it what I've been actually prepping you for? You get bad news on a Sunday night, the markets come screaming down on a Monday, and you get Tuesday bounces in the market, maybe sometimes in the Wednesday too, and then we go through the cycle until we run out of the news on the coronavirus. Now remember, Italy's still in trouble. We're a couple weeks behind Italy, and they're still seeing a lot of cases, so I don't know that it changes here. Restaurants, bars closed. I just heard all the YMCAs in Chicago are closing. The public schools are closed. Catholic schools are closed. I can't imagine movie theaters are still open, but they are. But it's going to be more and more that we get into that scenario. Is it scary? It is. Is the Fed coming to the market? It is. But the Fed can't stop the impact of the COVID-19. It can stop the freezing up of the banking system, and that is their goal. Now remember, we have a two-day FOMC meeting that begins tomorrow, finishes on the 18th, and every day we're seeing more and more bad, but that too will run its course. So let's take a look at what we've got. When you take a look at this market, you've just gone from 33.81 down to 24.16 in the S&P. The 2200 level seems to be a chartist area around the 2250 that many chartists think this market can finally bounce from. We'll see if that's the case. But on a weekly chart of just closes, it's been very much in a 1/3 down cycle. You can see how far you are. When we come to a daily bar chart, we keep reaching down on the break, and we've got that clean pattern of lower highs, lower lows. No, it has not stopped. To break it, you'd have to get way over up through here. That high, just so we exactly have it, is 2869.50. That seems very far away at this point. You can see today down 10% in the S&P. When we take a look at moving averages, we've had the bearish crossovers, and as they've set themselves into place right through here, this was on Thursday, the market is then making its new lows. So you're getting that bearish crossover, the algorithms pushing on it, all the markets still very much into a bear scenario. And now, of course, one of the things that you're looking at, will the 100-day average of closes, and that's going to take a while, it's a lumbering average, get under the 200 over time? Too soon to even know that. In terms of Bollinger Bands, pay attention to them, because what the market's been doing is pushing on them, then getting its bounce to the right-hand side of them, then falling back under them. Classic bear market play. Momentum-wise, what do we have? Well, both numbers today were under 20 that make up the slow stochastic. Oversold, but the day before both were not under 20. So let me show what I'm talking about here. To get an embedded reading, which is when you convert the market from locking in, and I know that sounds so crazy, but in this case, price has probably been ahead of momentum the whole way. You need to get both numbers under 20 going sideways for several days in a row. We have not had it. What we've instead had is a market crunch in price. It's rare that you see it this way. Typically, the momentum is leading the price, but that's what we've got, and that's because every day it's something brand new with the virus. I don't say that the virus will cause the financial malaise. The malaise can be handled between fiscal spending, I believe, and the Fed. What you can't control with money is the virus, and that is what we're seeing. In the Nasdaq, same thing. You hit the Bollinger Bands, you pop back over them, and then you go right back under them. So you've just come from a dramatic rise, nearly 10% on Friday, to a decline of over 10% today. If you're trying to catch that, God bless you, you're not going to be able to. It just goes back and forth in a wild ride, an overall bear trend, a lot of resistance up here. And I think, given the first hard rally, whatever it would come from, you'd probably see a lot of people just saying, I want to get out, uncle. Well, what can I say? When you come to the Dow today 11.26%. That's a big decline. And if we look at the gain on Friday, it was up 9.03%. So these swings are not typical, way bigger than you've ever seen, and something to learn from. But our work, you're under the 18-day average. You've had a bearish bias. You've had bearish crossovers. The swing lines have been down. Trying to play these markets because of the vast amount of margin it takes now, the money it takes to hold on, very difficult, as you know already. In the Russell, we were down today, near 13.87% in one day, and you were up on Friday 8%. So what keeps happening is we get those big gains, and the press picks up on it. Look at that 10% or 8% gain. What they're not picking up is the amount of declines that you're getting, and that's taken you into these 30% plus decline areas. Now, a recessionary market in the Dow, the S&P, and the like, often go down about 35 to 37%. They can certainly go to 50, but I'm just giving you what the norms are. So you're approaching those areas. In the VIX, I don't recall the last time we were in 82 on the VIX. The market has certainly got the fear index built into it. It's in a run, and you can see why with all that's going on, and you're very overbought. When we come to the bonds, the swing line is bearish. You've got lower highs, lower lows. You wouldn't know that if you're listening to the news in any manner. You had one test on Friday back to the 18-day average of closes. Here the momentum did its job perfectly. It broke the upward momentum well before price did, and then you made your run back to where we thought. Now the market is neutralizing itself here. We've got the swing line down, the bias up, momentum flat. 10-year note. I was hoping that it would get closer to the 18-day average off of the loss, but it still did its job. It gave you an idea that prices were coming down through here. You're not in the bear camp. Why? Well, too much risk, number one. Number two, you're looking at a market that still can hold at that 18-day average. It got certainly pretty close, and now it's neutralized itself again. In the dollar index, the first thing that happened, I had one of my brokers ask me this morning, Ira, why did the dollar break like that and go back up? And they're looking for a fundamental reason, and I'm trying to explain to them, it's the virus situation. It's worries about which parts of whose economy is falling apart, and the dollar's feeling those pressures back and forth out of almost panic. And I sum it up by saying, do you really want to own the yen? Forget gambling on it. Do you want to own the yen more than the dollar? That's one of the things you got to think about. The euro more than the dollar. One of the things you got to think about. Because when you're all in this case of this COVID, underneath it all, who's got the strongest economies? That's what you got to think about. But the swings, insane. We went from the 18-day average all the way down, back up. Now we're stalling at the 18-day average again. Eurocurrency, from Bollinger Band top to the 18-day average bouncing. Now, this market actually would get a bearish turn to it if prices were to get back under this 111.05.5.5. Get under there, close under that, you'd have lower highs, lower lows, the bias would turn down, and you've already got momentum teetering on trying to turn down. If the market rallies from here, you stay with the pattern of a lower low and a higher high. There's no way to change that at this point. In the Japanese yen, I understand that monster run-up, but look, we came back and challenged last Friday both the 100-day average and the 18, and this market did its job of holding it. The trend is down, the bias is up, and momentum is divergent in that it's pointing down. In Bitcoin, nothing is safe. This market has just seen itself halve in price from near $11,000, got down under $4,500, as you can see. What do you do with something like that? Well, it's probably getting too cheap under the Bollinger Bands, but it has an embedded reading. I don't care about the word cheap. I see a bearish crossover, and that crossover, just take a look with me. This was Friday, this is today, it just happened. Often when you get a crossover, a market tries to make a lower and low. In the differential between Brent and WTI, did you honestly think you're going to see when they're within $1 of each other? That's where they're at right now. And they're both in a state of collapse as Saudis are cheering on, saying they're very comfortable with $30 a barrel oil. How do you take that, Russia? And of course, the U.S. gets squeezed in between it as well. But you've got lower highs, lower lows, and embedded reading. Until it's over, folks, it's not over. WTI, again, just reestablished a downtrend, lower highs, lower lows. It too is trying to get that momentum to embed. Both numbers under 20 today, both numbers under 20 on Friday, and both numbers under 20 on Thursday. So you've got your embedded reading. Until it's lost, the market is saying lower lows. Maybe we get to the lower Bollinger Band in this. Gasoline. I didn't even know how to tell anybody today. I told one of my friends, you know what gasoline, wholesale gasoline is going for? And of course, they're guessing $1.40, $1.50 or more, 70 cents. So here is a market that was $1.90 back in January. And it has taken that out and gone down over 50%. Just got smashed. Nat gas. Nat gas is holding. Nat gas is trying what we talked about. It's trying to hold this 18-day average. I don't know that it can go anywhere with this. It's got lower highs, higher lows. But what you're seeing is that the market is starting to balance it. The market is saying, you know what's going to happen? Less oil is going to be produced. We're going to have less natural gas, which is a byproduct of that. And the market is already responding to it. Again, it's not trending tonight, so I don't know what to tell you with that either. What I can tell you is in the mornings, I want to get you started. Now, when I say in the mornings, I start recording my morning video about 5:40 a.m. Daylight Standard Time. And the idea there is to try to give you confidence in ideas you might have. I might also try to be instilling with you, don't trade. In my written updates for a week or so, I feel bad that I'm telling people not to trade, but I feel great. It's the right thing to be doing because it's like throwing a dart. Can I get lucky? It has nothing to do with skill. You go in over the weekend to a position. I've been betting it would be bad each weekend. It is. You come down, and then it's like I'm saying tonight. Maybe you get the Tuesday reversal day, but it's not a trend reversal. It's a bounce. I cover all these markets in detail just in this sequence. And the idea there is to give you what I'm seeing. I'm not just going to talk over the markets. I'm going to give you the idea of fundamentals, technicals, where to enter, where to get out, what to do. $7.95 for 30 days. And I am giving you 2 weeks free in addition of my Spider ETF video, and that you get with it. So now if you're a stock trader, you see that. I've already published it on the website. I typically get it out around 4 o'clock in the afternoon. So it's not a bad deal. How do you get it? Go to our website, go under the word research. It explains it, and you sign up right there. I'm Ira. You have a good day.